Hello, Alpha Public. Is anybody there? Is anyone on chat? No viewers. Where is everyone? Anybody got any early questions? Anyone wanting to join in? Bletchley Trades is here. Is the mic all right today? So do we have any questions about what's going on? I've obviously not been around much for the last 8 days, so I'm playing catch up myself. It looks like it's been a bit like we expected. Hello, Focus Trader. Gold, obviously, what a breakout. We've been waiting for that breakout. Could we get that wave 4 bottom in? And it looks like it happened yesterday. So Nagel was speaking overnight, I think, talking about resets on central bank policy regarding gold. And I think that kind of got the juices going for everyone. So it looks like that 22.77 is the low. So let's have a look at that. So all to imagine, remember where we were coming from. We're in that one wave up with a minor 2 retracement, and then it's all about how we're dealing with the inner waves. So I think we're still in the third red wave, and this has been a really complicated sideways contraction. One sec. Let me just pop my chat out. I can see what you're asking. So RBA, as in the Royal Bank of Australia. So Charlie Sim, when you say, what do you think of the RBA? You're talking about the Australian Central Bank? Or yes, give me a 100k account. That'd be lovely. Sourish. So anyway, back to so what do you mean? Why they haven't? In what respect? About the RBA? They haven't got a lot of room to manoeuvre, have they? Really? I think historically, when they change their monetary policy, they will go hard, but they're not going to do anything until. Well, it's kind of they're sort of split, aren't they, between dovish and hawkish? They want to be able to go, but they need the data to tell them. So until that all calms down, they're not really going to cut rates. I think they're determined, and didn't they change? That was New Zealand, wasn't it, that changed their underlying focus and what they were following, went to a single inflationary target. I think a lot of these central banks, they're all queuing up to get their policy less tight, but it's literally they can't afford to make the mistakes. It's really encouraging that Sweden went this week. That was the first cut for 8 years, wasn't it? I think. The ECB, other than some disastrous data in the next few weeks, will definitely go. And yesterday, the UK, even the negative people like Pill, the economist, he kind of left a little bit of a chink of light in there, didn't he, to say, even if we cut, we're probably still restrictive. So they'll probably use that as an argument that policy is really tight. Once you start seeing a number of these go, then they all historically tend to make a move in line because they can use the other people as an excuse. So on this gold thing, We've been following it for a while, haven't we? Saying, are we going to do the double extension? Which it looks like we did. So if you remember, the idea was a 3 swings here from the all-time high, a down and up and a down. And then in here, we were confused whether it was breaking out. We thought in the end that was an extension. And then we've been working our way down to what looks like last week was the low of the whole double extension, so that you can count 1, 3, 5 swings to that low. So in here, it was all a case of, was this sideways consolidation here going to take us down to one final cleaner low before it all broke out? It actually looks like that is a 1 with a consolidation 2. We'll look at it a bit closer. Why do most central banks wait for the Fed? Because, and that's a good question, Charlie Sim, it's because they are basically the rate setters for most of the debt in the world. So most emerging market debt, etc., is priced in dollars. So it is important what the Fed's policy is. It's the leading economy. So nobody really wants to get too far away from that because it causes emerging market pressure on those currencies. So if you get out of line with the Fed, you suddenly start importing inflation. If your currency becomes very weak relative to the Fed, then you start importing inflation. And then there's a real dynamic between China, Japan, and the emerging market Asian currencies. So if any of those start getting put under pressure because of the dollar, it all cascades into a bit of a forex challenge, and that's when you start getting defaults on being able to pay the debt. So it's a kind of falling domino. So nobody really wants to get too far away. So a lot of the Asians and the GFC actually went early and they put up their rates afterwards. So they were hoping to cut the rates quite quickly, and they don't want to have to do that and see the dollar stay strong, because as I said, that'll make them look weak. They'll start seeing outflows when really they need inflows of capital into their countries. So the Fed becomes very important. Everyone needs to be confident that they're moving kind of in line with them. But America has certainly gone out on its own at the moment in terms of economic performance, and hence the interest rate. So they can take their time over what they do, which is why I said before I went away that that policy meeting did Powell realize that not only is he doing his own economy and a dual mandate of employment and inflation, but he's having to look after the world as well. So it is a risky move. Yes, good question, to go before the Fed, unless you're very confident that your economy needs it, which is what Sweden said. They are definitely doing their own thing. So the only one that has been harshly punished really is the UK, because they've been really highly correlated with the moves in the dollar, and so it's been a sort of pseudo dollar currency, when really our economy is more like the basket case of Europe. So hopefully that's going to start diverging. All the language is about changing the interest rates in line with Europe rather than the US. So hopefully, is that clear? Is there any other questions on relative? It's all about relative interest rates. So this is why the carry trade persists in Japan and between Japan and the US, because you can borrow very cheaply at almost 0% and invest it for, if you're clever, anywhere between 7 and 10% with not a lot of risk. So yeah, it all really comes down to runs on currencies, which, emerging markets, they only have small amounts of assets, reserves, etc. So BRICS, well, the BRICS are planning on having their own currency, aren't they? So at the moment, they'll probably don't mind causing any kind of angst if they can. So Russia, they've already announced that they are in the planning phase over the logistics for a separate currency. So this is the danger. This is why you've got the whole gold thing going on. Is there an effect on the dollar? Then eventually it'll be a two-edged sword, because everyone still dives into dollar for safety as a safe haven, but as people lose confidence in it, then eventually it will just start to get hit. So there might be one last hurrah left in the dollar if you do get a crisis before it really gets sold off. For that, you need an alternative. So there is blockchain. The blockchain behind cryptocurrency is the thing that's key, not necessarily any of the cryptos that are in existence at the minute. all the central banks are working on the CBDC, a central bank digital currency. So you know it's in the background. The BRICS, by the sound of it, want to have their own currency, their own gold exchange, and they want to have an element of physical assets in their new currency when they do it. So that again is another one of the gold arguments, as we know. So there's a shortage of gold. Gold is needed to be held because of the Bank and International Settlement 85% thingy, which means every time people want to settle in gold, someone's got to find it, and there isn't a lot of gold around to actually trade. When you're trading gold, you're doing a financial trade, and 95% of the trade in the real world is paper, and this is where all the issues are coming at the moment. UK banks raise their mortgage lending rate, Bletchley. Majority must see higher for longer in UK. Well, they kind of have, haven't they? Because it has gone on longer. But I said, I don't know if my tweet went out. It went out on our system, didn't it? No, it didn't. It went out on the tweet yesterday. I was saying that Bailey was showing a lot of confidence lately, and he followed it up on a Bloomberg interview yesterday, and he said there are two factors at play why he thinks that the markets might not even be right on the amount of rate cuts. So it's either going to be more than 2 by the end of the year or go below what their medium-term idea was of 3.75. I think from his language, it sounds like once inflation starts falling, which we're anticipating is going to be next month, and they've got 2 prints before the next Bank of England meeting, there's every chance they do one and they signal that there's room for 2 to 3, if not 4 by the end of the year, which was the original idea a few weeks ago. So that could very quickly cause some sterling weakness and get it back into line more with the rest of the world, with the dollar being out on its own again. Now, yeah, mortgage rates, they will come down very quickly once the rates start. It'll be a massive competition thing that goes on. So the fixed rates will come down quickly. It'd be a start to look like a kicker. At the moment, it is obviously very, very tight. I'm getting worried. I've got to change my mortgage in November. I'd like to see that to start come down. Fingers crossed. So the UK, having been the dullard in the indices, is suddenly, if it finishes up today, that's going to be 6 all-time highs, isn't it, in a row? Rate cuts in the background. GDP today said shallow recession. It literally did end at the end of Q4. And that was a bit of a breakout. Generally, the industrial and manufacturing numbers were good. Construction was slightly weak for March, but they're coming off a low base. Even though these things are small positives and beats, they're beats off real low levels. So it's not enough to derail the momentum thing. And Pill, like I said earlier, his mantra was he is very conservative, very hawkish, but he was saying that it's so tight, the policy, they can probably get away with 1 or 2 cuts and not look like they're being loose. So prepare for that. I think they're definitely going to go in June. They're just being sensible with the commentary. I saw one of the guys on the chat, was it Edward, start buying oil. We've been talking about that for a few weeks. And that has had all sorts of issues with the drawdown data missing. So very much looks like I'd said we're going to have that double correction, equal waves was 79. We've actually gone lower than that, haven't we, over the last week? Well, I've been away. Surely, I suggest 77 looks like it was a line in the sand. This week, API missed again, but the big one, EIA, that's the data you should follow first, did actually have a drawdown on the crude side of things. So you'd hope that would move in. The key data for oil on the week was in the China trade numbers, and the fact that imports were up and their economy moving, so that it was kind of back on track with their record trend of oil imports, which tells you that the economy is kickstarting. So you'd like to think that will help. So oil does look like it's certainly in a first wave breakout. That might consolidate, but it looks like we're back on the trend and should be back in the 80s for the US oil, I think, in the next few weeks. Are there any other specific questions? The dollar itself, that's been quite a long, drawn-out process, hasn't it? As we've mentioned before. Let's have a look at that in terms of the longer-term chart. So dollar, remember, the 1 month view, we're in a consolidation wave 4 from this move up that topped out in the end of October when the markets turned in 22. So consolidating or expecting a big drop in the dollar when this starts into the sort of 100 level and below. What's actually happened is we've ended up doing a double correction to put the B wave in at the lower levels on the daily. You can see we talked for a number of weeks. We've been looking for this eventual 1, 2 of 5 down to start. That's ended up being a double correction right up to 16th of April is the high that's held so far, and it looks like with the bit of the geopolitics safe haven trading going out of it, data starting to drop a little bit. We've since put in, we'll look at it in the hour time frame in a minute, but there's been a 5 wave down and a 3 wave bounce up. This looks like a 3rd wave, put a 4th in. So we're about to have one more down before it consolidates again. But this is all weaving down within the setup that we've got. It was all part of a 3rd wave. At some point, a bad piece of data, worse than the non-farm payroll last week even, and it's going to drop like a stone, is the idea. But at the moment, we're still kind of caught up in this noisy nesting 1-2s. Do webinars occur every Friday? Yes, when I'm around. Sorry, I've been away for 8 days, so there wasn't one on Friday last week, and I'm obviously not on Monday. So Mondays and Fridays, Charlie, we around normally around 1:30 UK time. There's potentially an announcement coming out from the team at 2 today, so I just wanted to get this out of the way so that you can concentrate on that if it comes. So yeah, but obviously there's my chat on Discord, and just come into me and ask questions at any point. I do a preview document at the start of the week that gets sent out to you, and I generally do a recording about that as well. But yeah, Monday we'll kind of preview the week and talk about anything over the weekend, really. This is sort of normally a summary of what's gone on in the last week from what we previewed, plus answering any questions that you might have. So dollar on just what I was talking about there. There's a sort of 5 wave leading diagonal there. 1, a 3 swing back to get you a 2 wave. Didn't take out the high. You often get that in wave 2s. That you often you might in your parlance. You probably call that a retest, and it held. Then I'm looking for a 5 wave impulsive move, which you very much got that there. 1 quick pause, a 3rd, and then the 5th wave extended. That gave us the 3rd wave down. We've had a 3 swing double correction there, and we're going to work out a 5 wave down here, probably to around the 104 level, put in a consolidation, and then we'll resume the downside. So it's still going to look, on the face of it, a little bit of like a range trade, but be prepared for playing your dollar pairs in that kind of fashion. There should be one more temporary short-term sell-off, a retrace, and then the next wave down after that will be quite big. Hello, Vivi. I love Sorrento. And the Banida, Regina, Giovanna. Did you see the picture? So yeah, yen interventions was next on my list. Obviously, while I've been on my travels, there's been a little bit going on with that, not surprisingly. Let's just find. So my setup for, I can have a look at silver, Mark. We did that on my last preview, if you saw it, which was all talking about the hi-ho silver on the basis that gold and silver were both primed for a bounce, and at some point, silver is going to catch up and should normally take over. It has been trading a lot like an industrial metal of late, and quite rightly, because the defense budgets that have been going up around the world, there's a lot of silver required for the rearmament deals that are going to be coming. But in general, the silver does bounce. I've said if you're going to play the ratio, expect the silver to catch up. I do think it's all, again, we'll go back and look at gold and silver charts in a minute. But just there's every chance that we are in the fifth wave now, within that -3 up. So there should be quite a bounce coming in gold if it doesn't retrace. And I expect silver to at least match that, if not overtake it, because that is a kind of the heavy lifting is the -3 until we put in. I'm anticipating a kind of 25.50 top on gold before that puts in a proper consolidation. So within that, this next move to there, I'd expect silver to really take off. There's been a lot of chatter about silver traders being bid above the price, etc. So here on UJ, we had that. We were talking about when the barrier goes, you'd normally get the double movement from what the maximum pullback was. So it's probably only done half of the expected move. This move here to be replicated the other side of the barrier breaking. 160 became the eventual line in the sand. They've not admitted it yet, but it's all in the kind of their accounting data. It's obvious what they've done, and then they came again, didn't they, on the non-farm payrolls day when there was weakness. So that I'm impressed with what they actually did in terms of maximum aggression, rather than just doing it defensively. They had to go at supporting the yen when they were in the ascendancy, when the dollar itself was getting hit. But we've come back, we've retested just above the sort of 152 barrier level here, which was that old intervention. In here, pretty much looks like, to me, that's probably done. It's enough of the correction. A three wave, a down, a bounce back, and off. We're probably in. That's probably a wave 3 top that led into the extension. We're putting in a fourth, and then we need a new high to finish that move off. So now that we've got in this whole move here, I've put in the parallel channel. It's easier to do when you've got wave 2, 3, and 4. Makes more sense then because you've got a lot of data, and that is suggesting, as we put in before, for a one spot 618 impulsive move. Whoops. Which is 163.5. So I'm anticipating at some point the yen to be back under pressure. The dollar, when it has its next consolidation phase, if Japan struggles, they've again tried to do the rhetoric. They've gone to visit the prime minister to make a little bit of a kind of mitigation, just to say that we're doing the right things, blah, blah, blah. They don't really want to spend too much, but it is interesting that there's a lot of chatter saying that they should just come out and change rates, which is what I said. If you start looking at the amount of money they're spending relative to putting rates up, the annual bill for the rate hike versus wasted money if this keeps weakening, it doesn't make sense. It would make more sense to put the rates up and manage the actual fallout of that. So I think they'll be forced into a third intervention at some point. And quite honestly, with that 152 there as a massive support, you can play this with, quite confidence that they're not going to drive through that unless they change rates. Use that as a stop loss. Be very careful, because the Japanese do have a habit of doing out there things with their monetary policy. And after surviving the Circumvesuvian, that was an interesting. That was like being in the Warriors film. I don't know if anyone's ever seen that in the New York gang movies. That was slightly uncomfortable. Good graffiti on the trains though. Very good. Rex, good morning, or good morning. Maybe you're right. So, any questions on my ideas on the UJ? How are people playing that? Has anyone been playing that at all? I know there's a slight delay. Any questions? No. I'm showing my gym. Warriors, come out to play. So yeah, Charlie, I think there is a retest of that yen intervention level, and I think it goes higher. I think that will probably attract a lot more people taking them on. I said they've been I've been impressed with what they've done. They did it on a holiday. They intervened on a holiday when there was very little, very few people watching, and obviously a lackluster session. And then they did it on the back of the US already being under pressure, so they had people selling the dollar anyway. I think there'll be a period again where it's the yen versus the market, and they will have to spend again. Like I say, I'd like them to get the market nice and short and put rates up, and then you could potentially have a 20 yen move if they did that. But are they brave enough? The data in Japan isn't being overly helpful at the moment because people aren't really spending, because even though the wages have been settled, it hasn't really fed through to people yet. So they're a little bit you've got a whole generation of people who've never had inflation, so they're having to get used to that. So they haven't got into this wage price spiral yet. Ben A, afternoon. I'm well, thank you very much. Hope you are too. So indices, what about those? Net, I think I mentioned it in a tweet on my way back. The earnings season is ahead. The Mag 7, despite a little bit of fluttering from Tesla and Meta, the numbers were good, and the Mag 7 was supposed to be up 34 to 38% for the quarter. They come in at 49 before Nvidia have even reported. There's got to be upside chance for that. So I think, and something I read, normally, yes, into Q2, the analysts, if anything, mark down Q2 earnings, and then as the quarter progresses, they tend to re-rate them upwards. Excuse me. Well, that hasn't happened this time. They've actually started upgrading straight away post Q1 numbers. So there's a massive underpin for indices. So I do think they keep breaking out. Calvin, you enjoyed the interview with Dan? Yeah, it's good fun, wasn't it? He was in sparkling form that day. Yeah, that was good. Enjoyed that. And hopefully, any of you guys can come to do those interviews. That was a good studio. I'm not sure if we're even going to use that again, because last week we were recording in Nottingham between Nottingham and Grantham on this fantastic site where Riz does his filming, and absolutely brilliant. We're building our own studio up there as well. So watch this space. Lots of good stuff to come. Well, the Nikkei is kind of Nikkei 225, Charlie. Yeah, good question. That is kind of it's been the leader, hasn't it? Because they had the more upgrades than anybody else. So I deliberately haven't updated this one yet. So we're where are we? So Nikkei, I've not updated this yet because I thought this is quite intrusive. It's quite instructive of what's generally going on. And I think if I were to redo this, that to me looks like every potential that this is actually leading diagonal again. This is where when you get a lot of overlapping. It's you're either getting nesting for a super breakout, or you're having if it looks consolidating rather than over impulsive. It's normally a series of 3 waves. I don't like truncation. So 1, 2, 1, 2. This is either building up for another breakout, or we've potentially put in a 1 and we've been consolidating, whichever way you look at this is set for further breakout. There's a little bit of chatter about the effect of the weaker yen. Obviously, that's been good for the exporters, but it's the first time this week they've really been bringing it into the mainstream, talking about it might not necessarily be healthy, put it as part of the rhetoric for sorting this whole situation out. But the underlying numbers are still good, and the focus is moving more towards the domestics. There's a bit of I haven't gone through the numbers yet. I will do for the weekly preview, but there's a bit of confusing inflows outflows data this week, which sort of sits with a little bit of consolidation flow, which is what you've seen. So yeah, this has been going sideways while the other indices have been breaking out. I expect as we go into what is likely that 3, 4, 5 heaven that we've always been waiting for since the start of April, and it looks like it's playing out. As we go into that Nvidia inspired top in the Nasdaq, I think the yen will, the Nikkei will take out this 3 high over here at 41,000. So look for, again, big stop loss down here to 3,600. You can find probably a better support here at 37.6 for short-term trades. I'd certainly be playing it that way for the minute. I think Nikkei and DAX, with everything that's going on in Europe, very strong purchases. And the UK finally has woken up and started leading. Remember, the UK can detach at times because even if you get dollar strength, the FTSE 100 is really a dollar index. So that sometimes is why it performs well when markets are in sort of risk off mode. So I'd expect the FTSE to consolidate if there's a dollar spike up and keep outperforming if it's risk on. So the FTSE is quite instructive. And chatting to an old mate who did a really good video yesterday, which you'll see coming up, real fun. There's some really good, clever bits in that you will find very interesting and very funny. But he was saying FTSE 9,000, don't rule that out for quite a number of reasons that he discusses. It's finally playing catch up. We mentioned, just remember on the UK, we've got 2 lots of wages and CPI data before the next update, and they're more or less playing their hand out in the open, saying that they're expecting that to fall markedly, and there is an energy price drop off in the middle of that as well, I think, which comes in June. So all the fundamentals are lining up to let sterling have that potential for extra cuts. So I'll just run through. Excuse me. Sorry, just have a drink. Mr. Knight, we'll go back to gold in a minute. We did touch on it at the start. There's a number of factors at play which we've discussed before, and they're still playing out. Just quickly run through these indices. Remember, we talked about whether the bounce from what I've put in as the wave 4 lows been working like a dream. We're looking. Remember, the last comment I made was when we were here, still below the top of the first wave up. I wanted to see it break up and hopefully go beyond the equal legs. We've got that now that it's above 1.236. You're starting to get into impulsive mode. I'm probably expecting around a sort of move up to around the previous high on the Dow. Then we'll see a little consolidation, 4th wave of that, and then get dragged up to an all-time high. That's playing out nicely. It was the first one down. It's now moving up quite well. We've gone back into positive advanced declines in total and in the aggregation. MACD, that's only just gone positive as we've been breaking up into this impulsive thing. So there's potential for more there. If this is a 3rd wave, remember, I expect to see 3rd waves at least higher than the 1st wave in terms of momentum. So we're looking for a charge up here on MACD, probably into 300s to 400 range. That should help us get to that all-time high challenge sort of zone. We probably have a pause. Then you'd look to have a 5th wave completion within this substructure and the overall intermediate wave, and that should have a lower MACD. You get dispersion into the highs, so that will be an obvious. No worries, RH9. We will come to it. So that is playing out in a classic pattern at the moment. So again, look for any weakness to pick up the Dow. That looks in good shape. The S&P, last time we spoke, we're down here and we said there was this massive volume level to break back through, filling in the gaps from over here. We've done that and held. We've been focusing on advanced declines for the S&P 500. They've gone way down here, haven't they? They've gone negative almost down to what it was it into the 20s once you do that. So the zero is 50% of stocks above their 50-day moving average. So minus 20, that was really low. That was getting you down to because you double that. That was down into 10s. And a really, really good bounce here, sort of 60% plus now above their 50-day moving average, in line with the movement up. Very happy with S&P for now. That looks like it's still in the forming third wave. And NASDAQ is interesting. Remember what I said earlier about once you get the second, third, and fourth waves in, the fact that we've now put in this intermediate fourth wave. What was a previous channel, if you've been watching before, was I'd left it as just being a small gradient change from the minor wave threes moving up. So I've redrawn that today. A 2 low, using the wave 3 high and drawing it through the fourth wave. That brings us the channel, which, as I sort of anticipated, would still keep us in line with the percentages that we'd drawn in before in predicting where this was likely to go. So it looks like all-time high. We're in the right gradient channel by the end of May. Remember there, look at that on the 23rd of May there, NVIDIA report on the 22nd. This is all, subject to anything going wrong. This is all playing out beautifully for that. What we predicted in April, the 3, 4, 5 heaven, we'd hit a 3, look to buy it into a 3 swing low, which we've had. It ended up being quite extreme. We stuck in there. We've had the bounce. All the big boys have reported. That's just a perfect scenario. So again, this might be in a consolidation pattern short term because we've had quite a move up. But look to buy. I wouldn't put you off buying here with a decent stop loss, or look to buy it as it comes back into this region. There is another big breakout coming. And again, look, we've captured. This has moved up. We're only just into positive territory. Again, if this is the middle wave in this blue wave 5, then the MACD was it technically qualifies because the MACD was negative within this state, so it has put in a high. But I would expect to see proper momentum challenging up here again. Look for that MACD difference up to sort of 300 again as we explode in what I'm anticipating a massive set of numbers from NVIDIA. Which just happens to be the next tab. So again, it started selling off in March, really, along the same time as SAMC. Had a 3-wave sell-off, 3 waves up to there, and then a 5. That looked like the end of the pattern, which is why we were quite confident. It was a 4th wave rather than the 5th. Classic, bounced off the 38 fib. So we're in here. Could be an ending diagonal because some people would argue that these are 3-wave swings that are going on. That could happen. We could have 5 sets of 3 waves that takes us to the top, just to keep it confusing. But anticipating new all-time highs for NVIDIA and to drag along the indices. Risab, any plans to remove 300,000 max allocation? It's not really a decision for me, but I know the last time I asked about that, there's no plans for changing. There may be other ways of doing things on the imminent announcement that's coming out that you might find interesting, but it won't be changing that on the CFDs. Right, Mr. Knight and others, let's go back to that gold chart. I'll keep doing that. Let's just get involved in the short term on this. So remember, we had that leading diagonal weeks ago, which has ended up being what they call a consolidation, a connector for what was going to be another 3 swings down. And we had that. We had a 3 swing there, 3 swing connector up, and then 5 waves. Well, a 3-wave swing, but finishing in a 5-wave crescendo into that, what is now wave 4. So it fits all the characteristics of what was going to be a 3-wave finish. I thought this was actually a bit messy, and you could have shown it as just a 3-wave to finish, which is why I suggested that there might be one more test, but that didn't come. So we've had a bounce up, which consolidated into, yes, I was actually talking to people. I was short getting off the train before yesterday's recording in gold, didn't like the fact it just wouldn't break down. So we're in this bit here, would not break through. Start to get a bit nervous. I can that because I wasn't around. I always think if you're not able to watch things like gold, you shouldn't really be trading it too aggressively. Obviously, put your stop losses on. You should be comfortable with your strategy, but I like to be able to watch it if this was going to be a turning point. So I just closed down. Wasn't available until sort of 7 o'clock last night, and God damn it, everything happened, didn't it? So we had that huge move up, and it went again overnight. Now, people attributed that to Nagel, the Buba chairman, who's part of the ECB, and they've been a big player of gold, and they've made the European Union get gold, become gold purchasers, one of the first to move in line with their GDP, which is a kind of early signal that a lot of people noticed that there might be something afoot in the future with gold and gold standards and backing currencies, etc. Because the ECB were already planning it alongside doing all this research on CBDCs, the digital currencies. So when they announced that they'd made a loss, remember I mentioned that a few months back, the Bundesbank, and they said, we're not bothered, we've got 200,000 tons of gold, and they've actually had that delivered back from America. And that was something else that I'd said. 10 years ago, they asked for it back, and America couldn't actually find it. Now, America is supposed to have got 8,000 tons of gold. That is another reason that the market thinks they've actually hypothecated or lent out gold that isn't necessarily theirs, and maybe even sold some. So they may actually be shorter of gold than you'd expect, or they may have some option future forward positions that don't look very healthy. So there's definitely been things at play that look like a market short of the physical. For anyone that doesn't know, I know it's boring, but I'll say it again, it's all about Basel III, Bank of International Settlements. There's new rules. Gold is the only other asset apart from the dollar that has reserve asset status globally, on the basis that you have to own 85% of it physically pledged with whoever your holding bank is or central bank that you hold it in. So that has caused a lot of this move up from 2000. We had that retest. China have been buying. Lots of other central banks have been buying. There's a couple of my videos going into it, all this in depth, which you can find on YouTube, which sort of collates a lot of good information that's been there for the last few years. But 95% of trade is financial. It only takes a small percentage of that. Just 1% change in financial paper trading into physical would almost triple the amount of gold required to trade. It's that bizarre. So the fact that people are actually settling in gold because they want to own it and they're importing it back into their own country to actually have it physically available in case anything does go wrong or you have this gold standard rush. You know, the only people who are neutral on this and have most of it is the Bank of England. We hold a lot of gold for a lot of people around the world. So yeah, that is what's happening. So the gold squeezes. I think we've had this sort of consolidation, geopolitical thing. Everyone's backed off, tried to get the market short at a lower level. And if anybody is asking for physical settlement, you've got carnage because nobody wants to be on the end of that. So they'll be offsetting that with trades, unwinding. So a lot of what also is in this, and you'll only see this if you trade futures to know what I'm talking about, is that you can trade different months. So they call them calendar spreads. So what historically has happened is America, with a lot of this printed money, and they want to make gold stay low so that it doesn't look inflationary, blah, blah, blah. They would be a seller, but they'd buy back the forward month, or they'd buy the forward month and sell the outer months just to try and compress the spread on the prices. But at some point, you can get called and you get chased up. And if anywhere within that matrix, you happen to be subject to a physical call, someone actually asking to be settled in gold, you're in all sorts of trouble. And then people know you're short, and you can imagine how helpful people are when they know you're short. Not at all. So that is kind of the momentum behind all this, and the central banks want more and more of it. China have got 32,000 tons in the country, all available to them. They don't export any of the mines from any of the mines they have. They've got they've encouraged people for 20 years to buy it as a nation, individuals, of which most people want to be supportive. So the setup is there. Very easily, we could be going into another move up. But again, it looks like we were discussing it earlier. We've just looked at a chart here. excuse me, we're finally getting a little bit of consolidation on the day. I was talking about how I'd actually put in how I wanted this to play out short term. It broken out of the wave 4 trend channel to the side. So if it was still going to be a further extension, we need this to come back within the red channel, which is not a million miles away from where the 38 fib would be. So if we've had a 1 move up, a 2 consolidation here, the breakout, if today's top is a third wave, a fourth wave pullback, we'd expect to be around 2350, and that's where there's massive amount of gaps here on not necessarily massive volume today. For a healthy move forward, I'd love to see that filled in. Maybe it's got one more high, you get a little retracement. If we are going to go higher again, after the breakout of that channel, another test of that, and off we go, I think. So this is healthy at the moment. I'd like to see this extend, come into this region here and consolidate. Then we probably are back well within that wave 5. But it's interesting. Gold is interesting. Keep playing it, but play it with tight stops. Shorting things that have a physical element in it can just get driven beyond belief. And again, the trend is your friend, isn't it? When it's trending up, if the last 3 months have shown you anything, and these are wave 3s, remember? We talked about all that nesting. There's a video on nesting. Wave 1's up, consolidation 2s, and then wave 3 breakouts. It's all the same mantra. You've got to be consistent with your thinking. If you're going counter trend, keep your stops tight. So is everyone okay with the kind of gold idea? I mean, we've now got a massive breakout for this to deteriorate again. It'd be very painful. And when I say impulsive, when you've got almost straight up gradients, that they're impulsive, they're breaking out. Whereas consolidations, you can see them, they are retracing patterns, tend to be sideways looking. So that's when your first guess is that's a 1, a 2, and a 3 again, and kind of proving it, because that is, once it's gone beyond equal legs, it's when you use fib extensions to show you equal legs, because equal legs tend to be the most common consolidation. So you'd expect a retracement from 1 for 1, 100%. Once it gets to 1.236, that's kind of getting on the border between the two. 1.618 is the length of the third wave normally. Can be multiples of that fib. So you start to think, once you get to 1.618, it's more likely you're in an impulsive environment. So that's something to watch out for when you're drawing these lines. So any questions on any of that? Because I'm going to wrap up in the next few minutes. Are there any other questions? And obviously, I'm back now for a number of weeks. I'll only be doing the occasional away day. So hit me with any things that you'd like to see on Monday session, for instance, when we're going to preview what's coming next week and reviewing how we finished off this weekend. Bletchley, thank you very much, sir. I've got any other charts I wanted to show. Looked at Nikkei. No, I'll talk about EU on Monday, and we'll go into depth on the FTSE because that's something we brought up. We'll have a look at the DAX again on Monday. So for the moment, I'm quite happy. That's helped me get back up to speed with where things are. They're sitting in that 345 area on the indices. Let's look at the Dow again for that. So remember my thesis into April, 345. The dollar sell-off has kind of been delayed into here, and it's helping create that risk-on environment again. Doesn't necessarily have to happen because we've got the earnings backdrop, which is super supportive. Earnings means growth. We've had inflows into some of the emerging markets and into Europe. That again is helping a bit of dollar weakness. The US data is just beginning to crack slightly on the employment side. So Powell, I think, handled everything brilliantly yet again last week. bought themselves even more time than I thought that they would. I thought they might be slightly more neutral. He came in all guns blazing that they're confident things are going their way. So September is back on the roster, isn't it, for a rate cut? People are starting to actually look at the dates on the meetings, which we've been going on about for weeks. November falls 2 days after the US election, so it's no longer political. So I think November and December are both hot up there. If there's not crazy data, I think they definitely cut November and December. It's now whether they do July or September. I think it's deteriorated enough that we're back on to that fine mix. Ignore the hawks rhetoric. They don't really want to change plan. Talking heads will be back with us massively next week, I think, more than anything in the States. Bailey, as we said, UK, he's in control. The hand on the tiller. He's got everybody in line. They've now got 2 people voting for a cut. Absolutely perfect conditions. Ramsden backed up his quite controversial comments of 2 weeks ago that got everybody jumping up and down that he was wrong. But he's actually, it looks like he's going to be proved right by the data, and he's backed it up with a vote. So everything moving in the right way for the UK. Earnings catching up. No, I'm good. We're in 3, 4, 5. Very, very happy. So if there's no more questions, we'll pick this up on Monday. So about 1:30, 1:45 on Monday, I'll put out a note on Monday morning. So thanks for joining us. As always, any comments, feedback, much appreciated. Thank you. RH night, no problem, sir. Hopefully we'll see you again. Robert Petrovsky, thank you, sir. Brilliant. Thanks for joining. And now everyone look out for, I think there's a potential announcement coming up around 2:00. So eyes peeled. Take care. Have a good weekend and trade safely.